Okay, we're going to get going here. Welcome to Lockheed Martin Retirement Maximization, how to not miss out on what you're entitled to get and get every last penny you can before your retirement countdown clock, and you know that you have one, shows zero. My name is Josh Strittmatter. Let's see if well, here we go. Quick disclaimer before we get started, everything we talk about is strictly educational. Please talk to your licensed professionals before taking any action on the information. Who we are, my company is Strittmatter Wealth Management Group. We've been in business since 2007. We are certified financial planners and fiduciaries. We specialize in retirement planning, investment management, estate planning, and real estate investing. I am the principal and owner of the company. My background is that I have a degree in finance, and again, I'm a certified financial planner, certified retirement counselor. Our course outline today is we're going to start off with some changes. They're not too recent, but they are changes. We'll talk about your Lockheed Martin Pension and how it works. We'll talk about your Lockheed Martin 401k and how it works, and talk about some strategies for those. We'll also look at your retiree health care and make sure you take advantage of that. Talk about your portable insurance that you can take with you once you retire. And then we'll talk about the top 10 retirement mistakes to avoid. And then I'll share with you a little bit about how we help you. So starting off with, by the way, if you have any questions, you are welcome to type that into the chat feature, and I'm happy to answer those as we go along. In fact, if one of you wouldn't mind just typing in there now, just to test it, we'll make sure it's working here. Let's see. I'm not seeing anything come across it. Give me 1 second, guys. Shows that it is on. So you can alternatively raise your hand, I believe. So let me know if you have questions. Let's talk about retirement changes. So back in 2006, Lockheed Martin froze their pension, which means it would not be eligible to all new employees. So you had to work there before that January 1st date to be eligible for a pension. And then they froze the pay component of the pension on December 31st of 2015, which meant it would go off of all of your historical pay. Then in 2019, they froze the service element of it, which means all of your future service years would not be credited. It would just be all of your historical. And then January of 2020, they established the savings plan where they contribute 6%, and that's automatic for all employees now. And that's on top of the 401k match. So those are the changes that have occurred to the Lockheed Martin Retirement Benefits. Let's jump into what is a pension. A pension is also known as a defined benefit plan. It provides a specified monthly benefit at retirement to eligible employees, and that's according to a vesting schedule. This has a formula for how this is calculated, and you can go on to your Lockheed benefits to get the calculation specifically for you. Also, depending upon whether or not you are in the union or if you are a salaried employee, your pensions may vary a little bit there. But for the purposes of what we'll be talking about today, these strategies will work for any type of pension. So comparing a defined contribution plan, which is your 401k, to a defined benefit plan, which is your pensions. What are the differences between your pension and your 401k, in other words? So a defined contribution plan, or i.e. your 401k plan, is based, or the benefits are based solely on the amounts contributed plus or minus any income, expenses, gains, or losses. provides an individual account for each participant. So you get your statement, you can see how your investments are performing. The employee or the employer may contribute to the employee's account, and indeed, Lockheed Martin adds a match to your 401k. Contributions may be based on a percentage of the employee's salary and or related to years of employment. Participants are often responsible for your investment selection. So that's something that's unique about 401k plans, is that you're responsible for your results. Retirement income is usually taxed at ordinary income when withdrawn upon retirement. That depends upon how you saved in the plan. So now they have 401k Roth contributions. You can also have saved post-tax. In both of those examples, the principal would not be taxed. It would just be the growth. With the Roth, there's no tax on the growth. Mandatory annual distributions must begin at age 73. So you have to start taking money out of your 401k plan by age 73. Compare that to the defined benefit plan, the pension plan. So benefits based on the calculation using years of service, Social Security breakpoint, average income, and accrual rate. And we'll walk through that formula in just a moment. Participants are not required to make contributions to the plan. In fact, Lockheed Martin makes your contributions on your behalf. Participants are not responsible for the investment selections. So Lockheed Martin is responsible for the investment selections and the performance. Retirement income is usually taxed as ordinary income when withdrawn upon retirement. And that's true for all pensions, is you'll pay ordinary income tax when you start to receive it. And then you must start your pension by age 73. So advantages and disadvantages of your pension are: the employer is responsible for providing the retirement benefit. The employee knows the retirement benefit amount in advance, so you can use that number based on your calculator to do your planning. Usually doesn't depend upon your ability to save. So again, you're not contributing. Lockheed Martin is contributing on your behalf. No investment risk for participants. That's a big reason why many corporations moved away from these, is that they were taking on all the investment risk. Plan assets are managed by professional money managers, offers tax-deferred retirement savings, may offer cost of living adjustments, although yours does not. Yours is a flat payout for the rest of your life. If insured, the PBGC guarantees most, if not all, earned benefit if the employer cannot afford to pay. Disadvantages: there's no individual accounts that's established for the employees. So you don't get a statement. You can log in and get a calculator created for you, but there's no individual statement that's mailed to you. May provide only a portion of the funds needed for retirement. So again, it's going to be whatever it is based upon how the different components of it. Plan is often difficult for employees to understand. Usually doesn't benefit employees who leave before retirement, because that can cut your benefits for leaving early. Benefits are typically not payable until normal retirement age. And then most plans do not permit lump sum payments, and Lockheed Martin does not have a lump sum payout. So how is your pension calculated? There are 4 components to the Lockheed Martin pension. The first is your final average pay. The second is your Social Security breakpoint amount. Third is the plan accrual rate. And the fourth is the credited years of service. So here is an example for the final average pay of a person who worked through and worked for Lockheed. Now remember that the average pay component was frozen in 2015. So it's going to look at the top 3 years that this person earned from the start of their time frame through 2015. And so it's going to take the average of that, and this is 67,666 in this example. So pretty simple component there. Next is the Social Security breakpoint. Social Security breakpoint is based off of the maximum wage base for Social Security. So if you didn't know this, Social Security tax is only paid on the Social Security wage base. It's right around 168, I think, this year, thousand. So any amount over that is not taxable for Social Security purposes. And so the wage base inflates every year, so that amount increases every year. And this looks at the average wage base for you based upon the year that you were born. And so that's the number you can Google and look up to see what number that is. The accrual rate is the third component. It's a factor applied to your final average pay used to determine your benefit. You have two accrual rates with Lockheed Martin. And for credited service up to 35 years, your final average pay up to the Social Security breakpoint is multiplied by 1.25%. Any final average pay in excess of the Social Security breakpoint is multiplied by 1.5%. And then if you have credited service in excess of 35 years, your final average pay is multiplied by 1.5%. So here's an example of this. So this shows somebody who is 65 years old, who's retiring in 2024 with 20 years of credited service. Their final average pay in the top 3 years is $125,000. The Social Security breakpoint for that person is $99,720, based upon being born in 1961. So we're going to look at the accrual rate below the Social Security breakpoint and multiply that by 1.25. So that's $1,247. And then anything above that is multiplied by 1.5%. So in this case, the difference between $125,000 and $99,720, that's the Social Security breakpoint, is 300. It multiplies by 100 or 1.5% is $379. We're going to look at years of credited service. It's 20 years. So simply what you do is you multiply the first of all, you'd add up the two benefit amounts. These are monthly figures, and you multiply it by 20. That gives you the total annual benefit pension payout of $32,520. And by the way, this is a single life payout. So this is just for the amount that's being calculated for what would be paid out to you for the rest of your life, with no survivors, no beneficiary. Monthly, that's $2,710. So all calculations for other payouts are based off of your single life payout in this example, that $32,520. Common distribution options are the single life only, which is what I just described to you. It pays out to you for the rest of your life, and then there's nothing left to a survivor in the event of your death. So if you die in day 2 of your pension, you lose. Lockheed Martin wins. Because there's no beneficiary. That's why they have joint and survivor payout options. And there are different options, but here are the two common ones: joint and survivor 100% and joint and survivor 50%. And so with the joint and survivor, it would pay out to me for the rest of my life, but upon my death, my survivor would also receive a payout. And it's whatever the percentage of my amount that I was receiving. So 100% means that I'd be receiving this, or that my survivor would be receiving the same amount that I was receiving, 100% of what I was receiving. The 50% means that that person would get half of what I was receiving. And then again, at the death of the second person, there's nothing left to any other beneficiaries. Pop-up provision is unique to Lockheed in that in the first 5 years of your pension, if you choose a joint and survivor option and your survivor dies before you do, your pension amount will pop up to the single life only amount. So what that implies, and backing up just a bit, is the single life only payout is the highest payout that you can receive. The joint survivors are lower because they're paying out over 2 lives, with the 50% being a little bit less than the single life only, and the joint survivor being the maximum reduction because it's paying out the maximum over 2 lives. So again, the pop-up provision allows me to pop up my benefit to the single life only, but that's only in the first 5 years. So if my survivor dies in the 6th year, I'm stuck at that lower payout for the rest of my life. And it's important to know what your options are and make a good decision, because once you make your election, you can't change it, folks. It's a one-time election. And so when some people are choosing the election, they're going to choose the joint survivor option. And in doing so, what happens with the joint survivor option, the way that they're able to do that is the insurance company is actually buying an insurance policy on your life, which would pay out to your survivor in the event of your death. So you can do the same thing. And this is what pension maximization is. Pension maximization is the idea of taking the single life payout and buying your own life insurance policy. And so here's a hypothetical example of two payout. This is Bob. He's got a single life payout of $28.75. He has a joint and 100% survivor of 2010. The difference between those two payouts is $865 per month. So if Bob can buy a life insurance policy on his life that is equal to $865 a month or less, and that benefit will pay out $2,010 to his survivor for the rest of his or her life, then he will benefit from pension maximization. And the reason why is that in this case, it's his wife, Julia. If Julia dies in year 6, remember with the joint survivor payout, he'll be stuck at that lower amount. But with his own payout, where he chooses the single life and he buys his life insurance, it doesn't matter when Julia dies. When Julia passes away, he can simply cancel the life insurance policy, and then his benefit would be just the single life payout. And so, again, what you're looking to do is buy a death benefit where the lump sum is based on the life expectancy of the survivor, and that it would pay out $2,010 per month. And again, the premium would need to be less than $865 per month. So again, if Julia dies first, he can cancel the policy, or he could keep the policy and change the beneficiary. Things to consider about pension maximization are that to get life insurance, you've got to qualify for life insurance. So you have to go through underwriting. So this is not something you want to wait till you retire to do. You want to apply for your life insurance, make sure you can get it, get that policy in hand, make that first premium payment, then choose your joint or choose your pension option. If you do it the reverse and then you're unable to get life insurance, there's not going to be anything for your beneficiary, in this case, Julia. So very important to get the life insurance first before you choose your pension option. And then the question becomes is how much life insurance do I buy? Well, we have a calculator that we use. And in this case, to replace that pension, the lump sum required today to replace $2,010 per month based upon Julia being 60 years old and 65 at retirement with a life expectancy of 90 years old is $322,000. So $322,000 rounding up to $323,000 is the death benefit that in this case Bob would need to buy to replace the pension. Now, something that's interesting is that with the pension maximization strategy, the life insurance need actually goes down every year. And the reason for that is that Julia is closer to her life expectancy as each year passes. Therefore, she would need less money as each year passes. So a strategy that you can use is when you're buying the life insurance, you can either do what's called just buy one cash value life insurance policy. Cash value, also known as permanent life insurance, is whole life, universal life, variable universal life. Those are permanent policies that will pay out when you pass away, no matter when you pass away. You compare that to term insurance. Term insurance is for a specific period of time. So a 5-year, 10-year, 20-year term, if I pass away after that term, when the term expires, then my beneficiary does not receive the money. So you need some sort of permanent life insurance to use this strategy and ensure that a beneficiary receives money. What you can do though, and so the cash value life insurance has two components to it. It has investment and life insurance, whereas term is just life insurance. Because of that, the term insurance is much less expensive than the cash value life insurance. So a very effective strategy to keep your costs down is what we call a life combo strategy. A life combo strategy is where you use both permanent and term insurance. And in doing so, what you're doing is you're looking at the 20th year need for life insurance. In this case, it's 121,000. So remember the life insurance need in the first year of death was 322,000. When the 20th year, it's 121,000 because the beneficiary, the survivor, is closer to their life expectancy, so they need less money. The difference between those two values is the 200,338. So what you can do is you can buy a 20-year term life insurance policy for for the death benefit of 200,338, and then the remainder of the rest of the life expectancy of the survivor would be covered by a permanent policy. So you'd buy a permanent policy for 121,000 in this example. And the benefit of this, again, is a reduced cost of life insurance, which often helps you get over the hurdle of the difference between the two payouts. So if you look at this example, permanent only for 322,000 is $266.50 a month, or $31.98 a year. But a term plus perm combo is $11.44 a year, $13.89 a year. So a total of $25.33 or $211 per month. So that's an annual savings of $665 that you save by utilizing the term perm combo. So not only does this get you the same payout as what the joint payout option provides from the pension, it actually produces even more money. And that's why they call it pension maximization, is you can actually achieve more of a payout when you have insurance that is below the cost of the difference between the two payouts. So very effective strategy, folks. Again, it implies that you're insurable. So you want to make sure that you can get insurance before you choose the payout option. And again, the term perm is a very effective strategy to keep the cost down for you. So that is pension maximization. Let's talk about your 401k plan now. So Lockheed Martin has an excellent 401k. They match you 50% of the first 8% of your contribution, dollar for dollar. So you can contribute up to $23,000 in 2024 for salary deferral. This is an IRS limit. An additional $7,500 catch-up contribution if you're over the age of 50. So a total of $30,500 per year if you're over the age of 50 is what can be contributed to your 401k plan. You can contribute either pre-tax, post-tax, or Roth, and that would depend upon your tax brackets. Something to note is in 2026, the $7,500 catch-up contribution is required to go into the Roth provision if your wages are over $145,000. That's new as of the Secure Act. And this just shows you a very simple graph, is if you're contributing different percentages to your 401k. So if you contributed 8%, you get 4%, 6%, you get 3%, 4%, you get 2%. So again, yes, you're going to have less money because you are contributing less. The takeaway is that everybody should be at least contributing up to the 8% to their 401k to get that free money, that match. The other benefit that Lockheed has is they have the ability to actually save more to your retirement plan. So you can contribute up to 40% of your base salary above the IRS limit. So the maximum contribution for profit sharing is the lesser of 100% of compensation, or $66,000, or $73,500 if you're over the age of 50 in 2024. This means you can put in more money than the $30,500 limit. Now, something to note is that when you contribute post the IRS limit, it does go into the post-tax account. So it can't go in pre-tax. You don't get that write-off. So, but it allows you to put a lot of money away into a tax-deferred account, which is a great tool for retirement. Another great thing is the Roth IRA, or the Roth 401k, I should say. So many Lockheed Martin employees, when they first got started, they saved to a post-tax bucket. And this was before they had their Roth 401k. So what's unique about this rule came out a few years ago, probably over a decade ago, is you can take your post-tax contributions when you roll your 401k to an IRA, and you can roll them directly into a Roth IRA. So commonly you get two checks. You get a pre-tax check, and that would go into your traditional IRA. Then you'd get your post-tax check, and that would be deposited into your Roth IRA. So very important. And then again, is you can also receive a third check if you contributed to a Roth 401k. So important thing to note is that all post-tax contributions into your 401k can now be directly rolled over into a Roth IRA. Now then, the 401k is what's called a direct transfer asset. A direct transfer asset means that it bypasses probate. In order to do that, you have to have named a beneficiary. And what I recommend that you do is if you want to bypass probate, and many people do, is to have both a primary and contingent beneficiary. So a lot of times you'll name your spouse as the primary, but then they don't name anybody else. And then if you both die in a car accident, it has to go through probate. So a contingent beneficiary helps to prevent it having to be probated. Probating means you got to hire an attorney to get the money out of it. So the direct transfer assets means you can name a beneficiary. What I recommend that you do is print those off and keep those with your estate planning documents, because that accomplishes two things. One is that you know that you did it. And secondly, is it's easy for your executor to know where that money's going. Now, the other thing to note about a direct transfer asset is that they trump all of your other documents. So a will or a trust, whatever is in your direct transfer is what's going to happen, folks. So if you got divorced and you forgot to change the beneficiary, it doesn't matter. Your ex-spouse will receive your 401k. Another reason why you want to make sure your beneficiaries are up to date. Now, many of you have saved to the company stock plan. And in doing so, you've done so for many, many years. And there is a strategy that you can use that can help minimize your taxes if you do it correctly. It's called net unrealized appreciation. So the way that this works, folks, is that when you roll your 401k to an IRA, you can roll the stock and the cash into your IRA, and then it's not a taxable event. So that when you distribute that money from your IRA is when it would be taxable, and only when you distribute it. An alternative to that is to roll your cash out to an IRA and transfer your stock to they call a taxable or a non-qualified brokerage account. So not an IRA. And what happens when you do that is it becomes a taxable event. And what that means is that you're going to pay tax on the amount that you're transferring. However, there's a special rule when it comes to stock. And that is that you will only pay ordinary income tax on your cost basis, the price that you paid for the stock. All the gain, you won't pay tax on it until you sell it. So what you want to do is transfer it to your non-qualified account, make sure you have money to pay the taxes, and then hold on to that stock for at least a year so that you can take advantage of long-term capital gains taxes before you sell it. And that's typically 15% for most people is what they pay. It's 0, 15, and 20% depending on your tax bracket. So The strategy again is to not roll the stock to the 401 to the IRA, but actually to roll it out into a non-qualified account. This doesn't work for everybody, so you have to do some calculations because there's some additional things that you need to look at to make sure that this is going to work for you. But the hope is that you'll pay less tax on that bucket of money that you had in stock. Retiree medical insurance. So some employees may be eligible for medical coverage after retiring from Lockheed Martin. Enrollment may begin at retirement or upon the commencement of your pension benefit. This coverage may be different than your existing coverage, and you can receive quotes by calling the service center. There's the phone number. This may be subsidized by Lockheed Martin. So comparing coverage would be beneficial for you. And this is both coverage before Medicare and after Medicare. They have a supplemental program for Medicare as well. So if you're not aware of that, oh, and there's the Medicare plans right here. Yep, subsidy for the health reimbursement is through a health reimbursement arrangement. This helps offset some of the cost. You must enroll in Medicare Part A and B, and must enroll through the via benefits or have TRICARE for life to be eligible for the subsidy. May enroll later and still be eligible for the subsidy. So be sure and get the information on that if you're looking at getting close to Medicare age 65. You also have access to a health savings account if you participate in a high deductible health insurance plan. Lockheed Martin has a high deductible health insurance plan. So, but you have to have elected or have chosen that when you chose your benefits. Now, all of you guys are going through your benefit enrollment right now. So this may warrant you looking at this to see if this would be beneficial to you. But the high deductible plans have the are called HSA eligible. And HSA is a health savings account that you can save to pre-tax dollars and then use that for medical costs or medical expenses. And there's a few benefits of this. The first is that when you save to an HSA plan through your employer, you also don't pay FICA taxes, which is 7.65% of your pay. So you don't pay FICA taxes, you don't pay income tax. And if you use it for medical expenses, you never pay tax. So it's the only account out there that you don't pay taxes on. Great way to save money, folks. The other added benefit of this, I think that's on the next slide. Yeah, is when you turn 65, you can then begin to use it for other types of expenses. Now, you'll pay tax on the gain when you use it for other expenses, but you won't pay the penalty, which is 10%. So if you use it for medical, there's no penalty, no taxes. If you use it for something other than medical after the age of 65, there's no penalty, but there are taxes. You do not forfeit these, so you don't lose them every year like you lose your benefit of the flexible spending account. This accumulates. It's your money. When you leave, you take it with you. Once you turn Medicare age, you're no longer eligible. I should say, when you start Medicare, you're no longer eligible to make contributions to HSA. So keep that in mind, folks. And again, let's see. Those limits are quite high. Looks like we don't have the limits on there. I believe they're between $7,000 and $8,000. If you're over the age of 55, that's for a family. Half that if you're single. If you're over the age of 55, there's $1,000 catch-up contribution. So you can put away a lot of money into your HSA if you're eligible. Okay. When you retire, you're also eligible to take some of your insurances with you. That's called portable insurance. And so what you're eligible for is employee term life, the group universal life, which is a permanent life insurance policy, special accident, dependent optional term life, supplemental medical, long-term disability. And if you were around to get the long-term care insurance many years ago, that goes with you as well. So folks, before you retire, you might take a look at your different insurances to decide if you want to take any of it with you. All right, here are the top 10 retirement mistakes that you would like to avoid when you retire, and even as you prepare for retirement. Number one, not taking advantage of your full 401k match up to the 50% of 8%. Folks, again, that's free money. That's a no-brainer. Get that free money. Not taking vacation and then retiring, so using up your vacation pay. Not using the pension maximization strategy if you have a pension. Not using post-tax portion of your 401k to save more money. Again, you can save up to 40% of your pay. Not rolling post-tax portion of your 401k over to your Roth IRA when you leave. Not naming a beneficiary on your 401k. Not taking advantage of a net unrealized appreciation for your Lockheed stock. Not utilizing the Lockheed Martin healthcare and Medicare benefits. Great benefits. Not contributing the maximum to your health savings account. Again, that's a great tool to help you save money. Not utilizing Lockheed Martin Guaranteed Universal Life. That's a great tool to use to take with you for life insurance. And then bonus, not using Strittmatter Wealth Management Group to plan your retirement. All right, folks, what are your next steps? Well, what I would do is begin to gather your information, write down your objectives and questions based on what you've learned in this class, and then take action. We offer a complimentary consultation, and I'll tell you more about that in just a second. We do comprehensive financial planning, retirement planning, tax planning, estate planning. We are certified financial planners, flat fee for financial planning. For investment management, we are an independent registered investment advisor. We have no proprietary products. We are completely independent. We use institutional style investing, flat percentage charged. For insurance, I have an independent insurance agency. We can help you with long-term care insurance, life insurance. You can schedule a meeting to request more. We have great blogs. We have a Lockheed Martin blog if you'd like to register for that. You can sign up for our newsletters. We have great classes that we teach out at local colleges. I've been teaching out at UTA and Tarleton for 14 years. So you can go to their websites, or you can go to my website, strittmatterwealth.com, if you'd like to attend a class. We offer for Lockheed retirees a couple different reports for free, folks. So the first is a pension maximization analysis report. So this is where we do the calculations to determine how much life insurance that you need. And then we can quote the life insurance to determine if it's going to work for you. And then we can help you to get the life insurance in place if it will work for you. This report is valued at $500, but we offer this for people who attend this seminar, but the offer expires today at 5 p.m. If you would like to schedule that, and by the way, this is missing something. Let me see if I skipped over it. Oh, I did. I skipped over it. We also offer a 401k analysis report. So this is where we review your 401k portfolio, look at how you've invested, give you recommendations on how you should invest, and then talk about ways to reduce risk, how it should be structured for you for retirement. Again, report valued at $500. We offer this for a limited time. It expires today at 5 p.m. If you'd like to receive those reports, you can click on the QR code here or go to that website at the bottom. And in doing so, it's a scheduling app. It's Calendly. You can schedule a time to meet with us for a discovery meeting. That's a Zoom meeting. So we simply just gather the information that we need to do the analysis, and then we'll meet with you in person to present that analysis to you, or over Zoom if you're out of state. You can do that too. You can also request, when we talk at that time, you can also request a meeting to go over comprehensive planning as well. And we can also discuss that then. So click on that QR code if you'd like to schedule a meeting or to request those complimentary reports. And again, you can also go to that website if you don't have a QR code reader. Everybody has that on their phone, by the way, if you didn't know that. Most people know that these days because of COVID, though. So, folks, I hope you, let me put that back for you. Second. There you go. I hope you've enjoyed the presentation. We will send you a copy of this presentation so you can review it again. You're welcome to forward it to your friends if you'd like. If you have any questions, give us a call. We're happy to answer your questions. But I hope you've enjoyed it. Have a wonderful weekend. Thank you so much.